Okay, gentlemen, I think we might as well get started. I'll make some preliminary announcements here. Thank you all for joining us. It looks like we have 12 or 13 attendees joining us this morning. This is the COVID impact on M&A markets presentation with Flatiron Law Group and Falcon. Falcon will be our lead discussion today, but we're going to start off with an introduction from my partner, Conrad Everhard of Flatiron Law Group. Just a couple of housekeeping issues. Remember, everyone, this is a recorded session. Two, to the extent that anyone in the audience has a question, please type it in to the question and answer box on the webinar platform. We will either answer your question because the speakers can see your questions. We may choose to make your microphone live to the extent that you want to join and ask maybe some interactive questions depending upon time. We'll see how it goes. We don't have a particularly large group, but we do have 13 attendees, so we may take the opportunity to allow some of you to speak up and ask your questions. With that, I'm going to pass it over to my partner, Conrad Everhard, who will kick off today's COVID impact on M&A markets. Conrad?
Hey. Welcome to Climbing Out of COVID. I'm Conrad Everhard. I'm an M&A partner, one of the founders at Flatiron. I'm here with my colleagues, Ted Stack and Mark Waito from Falcon Capital. This is a joint Falcon Flatiron production. I want to give you a quick overview on the series. I'll give you a quick introduction to Flatiron, then I'm going to turn it over to the Falcon folks. This is a 6-part webinar series diving into different aspects of the M&A process. I mean, as a preliminary matter, we are M&A bankers and lawyers, and we've been navigating these currents, these stormy waters of COVID for the past 9 months. And obviously, at the inset in the spring, the impact was fairly traumatic. If your deal wasn't far along, your deal was either put on ice or cratered altogether. And we were that way for a couple of months. But the landscape's changed over the past few months. We're actually busy. You've seen strong debt and capital markets have given strategic buyers currency and liquidity, and they've given private equity buyers an opportunity to achieve exits. There's been some sectors, frankly, and the Falcon folks will talk about that have benefited from COVID. You know, those companies which enable the virtual economy have benefited. For example, our client Business Licenses, which manages business licenses for retail and Fortune 500 companies, was sold last Thursday to Avalara for almost $100 million. Falcon's closed about a dozen deals this year. We'll close at least 8. So there is activity in some sectors, and we're not flying blind anymore. We have some data. The Falcon folks have data. We have some clarity in where the market is and where the market's headed. We've been able to discern some patterns about how deals are done. We've learned some lessons from the deals that closed and the deals that haven't closed. And that's what this series is about. We're going to dive into what, our insights into what's happened in the past few months. This first seminar is going to focus on the markets, where we are, where we're headed, how companies are getting valued, how sellers are hedging risk. The folks at Falcon are gonna take the laboring oar on that, and we'll participate. Next month in December, on December 9th, we're going to do our second session, which is going to focus on structuring companies, how buyers are structuring these transactions to defer risk and hedge risk. There's going to be a session on negotiation. There's going to be a session on getting your company ready, which is more important than ever in the COVID environment. We're going to talk about wealth management. And of course, we're going to have a session specifically dedicated to earnouts, my favorite topic, and the favorite tool of buyers to hedge risk in the pandemic era. Quickly, as Lenny said, you can chat with us, through the chat room. We can bring you up live. These are quick hitting webinars, 30 to 40 minutes and interactive. We're going to have a rotating cast of characters depending on the subject matter. We're going to have rotating formats. Today is going to be a little bit more of a presentation format. Quickly, by way of introductions, the Falcon folks will introduce themselves. Flatiron Group is a law boutique, a deal law boutique that's been formed by former big law partners. We do exclusively deals. That's all we do: M&A, private equity, venture capital, technology commercialization. And our innovation, our shtick is that we do deals on a fixed fee basis, basically flipping the model around for the big law firms. And we can do that because we leverage technology, both third party and our own proprietary deal platforms that we've created, and we deploy some pretty innovative strategies for labor and overhead. As far as me personally, I've been doing M&A law now for almost 30 years. Some of you guys here on this call know me. I was formerly a partner at Jones Day, and I was a partner at Bryan Cave and other places. I've also been in the private sector. I was EVP and GC at AE Polysilicon, which was one of the celebrated solar startups of the Solyndra era. And like Solyndra, we crashed and burned spectacularly, bringing $200 million of capital with us. We ultimately sold that company to Chinese buyers. So I've been on every part of the transactions in M&A as a service provider, as a principal, and as management. With that, let me turn it over to Mark and Ted to introduce Falcon and talk about themselves and get the presentation going.
Hey, thank you, Conrad and Lenny. So I'll kick this off, and Ted and I are going to frickin' frack together to go over some of the important topics that Lenny mentioned, and maybe some additional ones and ones that you might raise over the course of this presentation, this webinar. So just a little bit of a little commercial on Falcon. We're a 20-year-old investment bank. We're growing. We're based just outside of Philadelphia in Wayne, Pennsylvania. We focus almost exclusively on software and software-enabled services companies and services around tech and software. We do have a regional practice that does things in the commercial industrial world. Our clients historically are CEOs and entrepreneurs, founders, families. We also work with boards of directors and institutional backed clients. And really what we help those people do is either exit, that could be a full exit or a partial exit, say with a private equity partner or some other investor group. It could be it could also be another form of capital raising. And we also help people buy companies as well. Although I'd say in any given year, 90% of our work is where we're advocating on behalf of sellers. So that's a little bit about Falcon. And then without kind of going through these bios in detail, I think the takeaway for me and Ted is that we're former owners. We all worked at big companies. We climbed the ladders there. We dealt with the structure and disciplines and policies there. We parachuted out, started our own companies, and learned how to be an entrepreneur and a business owner. So we were the guys that were first in the office in the morning, and last going out at night, and dealt with all the PR, HR, business process, banking, legal, accounting issues that you need to deal with, plus trying to sell and create revenue for the company. I think Ted has grown up from a CPA accounting perspective, and I grew up from a sales and marketing perspective, and that's a little bit of the background on the two of us. You can dig in more if you want on our website, or we can send this presentation out to you later. What we're going to do today is kind of talk about three segments. We're going to break this webinar up into three segments. The first segment is a general market overview of what's going on in M&A. The next segment will be on what we're seeing, what Falcon's seeing, what Flatiron's seeing. And then we're going to talk about climbing out, how people are responding to this pandemic, whether they're operating and will continue to operate as a standalone company or as an institutional backed company, or in an exit scenario. So let me begin with global M&A by the numbers. And Ted, feel free to jump in here.
And
This is
put
from
your
Capital
slide
IQ.
up, Mark.
Excuse me?
Put your slide up with the,
Isn't it up?
we just had the first page.
Hold on for a second. I'm sorry, I thought I had these slides up.
Hey,
There you go.
yeah, okay, good.
On page 4. Good.
Sorry about that.
You're on page 4. Looks good.
So, global M&A by the numbers. This is sourced from Capital IQ, a database that we subscribe to, and it focuses on Q3. And what you can see in Q3 is that in the North American marketplace, we are down 50 to 75% over Q2. M&A overall has been dropping when you look at prior years. If you
Mark, just stay on that slide for a real quick second. I just want to make one or two quick points. I think as Conrad had said, if you looked at the progression of the pandemic and broke it up into, kind of the March, April timeframe, the May to, June timeframe, and the post-June timeframe. And I think one of the interesting things is by the numbers here, by all accounts, M&A has been significantly down, not only in Q3, but as Mark will show you shortly, kind of year to date in the numbers. But it feels like that, in that first block of those first 2 months, we had, as Conrad alluded to, just a frozen markets. No one really knew what was going on. No one really knew what to expect. Nothing really was happening in those timeframes. Things that were done in January and February closed in March and April, but certainly nothing that was in process in March or April got to the finish line. And then we started coming out of that, understanding a little more in May and June. And interestingly enough, I think we echo with the Flatiron folks. Post July, we've seen a dramatic, resurgence of deals. And in the interesting thing is that the deals are resurfacing, but we are still down significantly, to Mark's point, from a global numbers perspective. So I think in the context of talking about this whole pandemic and how it's impacting it, I think there's the comparison to prior years, but also comparison to this year in 2020 and how the year has progressed and what we expect to happen coming in 2021.
Yeah, in fact, to jump on that, even pre-pandemic, January and February, going Q1 M&A volume was off from the prior year. So I believe that, let me see, I got some data here from PitchBook, was that in the second quarter of 2020, there were about 2,000 deals, and they closed for a value of about $340 billion. And that was a decline of 41% in the number of deals and 24% in the value of deals from an already anemic Q1 2020. So we weren't, stepping into 2020, things weren't good for M&A in terms of, volume and deal value.
Yeah, interestingly enough, too, if we had done this presentation in November of 2019, we would have said, hey, upcoming election year, we've got lots of data on election year, financial markets, what happens in those markets, what happens to M&A. Typically, the market, nothing really dramatic happens in an election year in the stock market. A lot of folks are on that wait and see mentality, and that just got thrown out the window. So layer on an election year on top of this, and I think it's not only the pandemic. I think, quite frankly, as we're talking about, the resurgence that we're seeing, from July 1, that July date is very critical. Anyone that could be in market that was not impacted by market, that any anxiety over tax law changes, our recommendation was get to market. Anyone that was dramatically impacted by that situation, you were still in this wait and see mode. And obviously, just by the numbers, there were more folks in that wait and see mode that were able to take advantage of, getting to market, in a pandemic, time frame.
Yeah, so this next slide is really just goes into a little bit of more detail of M&A activity and on a quarter by quarter basis over the last few years. No need to really drill down on this. This is just illustrated to show what we've been telling you, that M&A has been down. And this too is another a slice of the data by region.
Yeah, I think if you forecast it out to Q4 and what we think is currently happening, it'd be interesting, Conrad and Letty, get your comments. But we are busier than we've ever been in this fourth quarter of 2020, and I think a lot of it was just deals that did get held up because of the pandemic. Again, I think deals are coming back. I think overall you're going to see a fourth quarter that's going to repeat from a statistical basis in comparison to prior years, i.e. the markets on a volume and dollar basis will be down. But there is no doubt that deals are coming back strong, stronger than we probably had thought at this point in the process. And it's going to be interesting, from a quarter perspective. Again, we had a lot of deals that are being rushed for tax reasons that could get done, that are being pushed to get done prior to year end here. Certainly anyone that wasn't in market prior to September 1 probably didn't have much of a hope to getting to a finish line by the end of the year. But I think Q4 will be down on a market basis again, but again, on what it feels like and what we're seeing in certain sectors, and Mark and I will talk about this in a bit, we do see activity happening.
Thank you. So that was the global view, and now we just want to give you kind of what Falcon has experienced over the last 10, 11 months here. So again, what the data that we're looking at is in healthcare tech and what I call enterprise tech, which is everything outside of healthcare, and a little bit of commercial industrial, but mainly in these two tech spaces of healthcare and technology. So last year, if you look over to the left, we did a dozen deals, and the average deal was around 15 million. This year, we closed 5, and we have in process another group of companies, and we think 3 to 5 of them will close by the end of the year. And we've seen that, Falcon, we transact companies all across North America and from California to Pennsylvania. So this would be kind of a national view on what lower middle market M&A transaction volumes are seen by a bank like Falcon. These are just some of the deals we closed. And the reason I brought this slide up is to show you the types of deals. And there are some interesting deals here. Ted, with the 2net, that, can you explain that a little bit?
Yeah, I mean, I think in general, technology has been pretty resilient to the pandemic, and kind of across the board. There's all sorts of supply chain issues and all that if you're in the manufacturing side of this, but if you're delivering software and software applications, not hardware, we've seen that those markets have been extremely resilient. That the 2net RPM, interestingly enough, you talk about benefiting from the pandemic. That actually business was Qualcomm Life. Qualcomm actually invested a lot of money, hundreds of millions, in developing a remote patient monitoring platform to basically enable remote healthcare communications. Francisco Partners bought that business, renamed it Capsule Tech. But within that, they had a patent portfolio of, basically, if you think about a healthcare Internet of Things that enabled medical devices, drugs, and technology to connect with the consumer. And you talk about the pandemic and just seeing that market just, kind of explode. That's a business that, quite frankly, benefited dramatically from, what was going on. It just, it was a business that everyone knew is going to continue to grow and accelerate over time. It just, became more visible that, telemedicine and remote patient monitoring, those types of things, just got accelerated dramatically. And, we think it's here to stay. So that's an example of a business that actually was benefited dramatically from what was going on in the marketplace. Well,
Yeah, real quick on the Dickinson Navisite deal, which was interesting. Dickinson, an SAP reseller and implementer, their whole pipeline, sales forecast pipeline, held up strongly, even improved over time as people rushed to implement newer technology to support kind of the new world going forward. And so where historically, you might not have thought as a reseller or an implementer kind of getting through this cycle easily, the Dickinson did. And that's just a credit to the management team there. Don runs a really tight ship and did a really good job. And it kind of points to how the rest of the market was responding to digital transformation and the adoption of those technologies.
Yeah, and Kiefer, if you look at what's on our plate, it's all software. It's all businesses that are more in need in today's pandemic market than before. We're impacted by COVID only in a sense of kind of delayed sales decisions, but all having strong years, all not really taking the COVID bump. And I think it's just so everyone kind of gets the angle. Our view of the world was we had several companies in market that were service oriented, or a lot of their revenue came from either a hardware or tech or a service perspective. Our advice was to take the company out of market, wait. And that wait became in July, wait till the first quarter of 2021 to reevaluate. And a lot of that just had to do, if you had to be in market explaining why your business was significantly impacted in COVID and getting someone to believe that it was going to rebound or forecast it was going to rebound without statistics, we just saw significant discounts being applied to those businesses. And if the business, really did only have a COVID, kind of bump down, that, our advice was wait till you get some clarity. You'll be in a much stronger position to go back to market and sell off of fact and numbers versus what you hoped to have happened in the marketplace. Now, not every business is in a position to do that, but, our advice in general had been, you do not want to be selling into a market and giving any buyer a reason just to discount the business, or to Conrad's point, change the risk profile to put a 50% of the deal in an earnout. There's no reason to take that risk in our mind. We'd rather, just sell the business outright and structure the deal. And typically speaking, those were businesses that anything was retail focused, including, healthcare retail focused healthcare businesses. Some of those businesses benefited if you were on the lab side or in urgent care or something like that. Again, you had also the problem of explaining to someone, and we've seen this more recently, that not only was revenue down, but expenses are down in a lot of these businesses. Non-travel, sales guys aren't going out. We actually think a lot of that actually survives post-pandemic. And so we've got a laser focus on really working with our companies, as Mark had said, with the management teams, to really being able to articulate what your post-COVID, strategy really looks like and P&L looks like.
Conrad, you or Lenny have any comments on?
I actually seeing a lot of the same stuff. So the deals we've done, and we've been very active, too active, is that they fall into two buckets. You've got the opportunistic deals, and then you have the deals where the sector is actually benefiting from COVID. And in the opportunistic deal, you'll see strategic buyers filling a hole in their product stack, and or a private equity buyer getting an opportunity to fill a hole in their company stack, which at a better valuation. We sold a remote browser company, a small company in Maryland, to McAfee a few months ago. It wasn't a great deal, Ted, and we had to do a lot of it in an earnout. But she was struggling and she survived, and now she's part of the McAfee family and probably will make the earnout at the end of the day. On the companies that are benefiting from, those companies that are enabling the new economy, and the business licenses deal that I talked about before is the poster child. People need to file their licenses with the government authorities, and they can't go there in person right now. So business licenses, business actually has accelerated during COVID. That precipitated a very rich deal that we closed for them last week. So yes, those are the two buckets that we're seeing. We're also seeing, like you mentioned, Ted, we're seeing expenses that are down. And as I was telling Mark before the seminar started, we're seeing cash that's up because they're not spending it, which is distorting the working capital calculation, oddly enough. But we've run into that problem. So it's an interesting dynamic going on.
Yeah, so actually we're going to talk a little bit more detail in for the balance of this webinar in many of the points that Ted and Conrad and myself are making. So what we're seeing, Ted and I are seeing a lot of different things, and I think this is just tags along to what Conrad just mentioned. You have the financial buyers out there, and they're raising funds. They continue to raise funds. They have a lot of cash. They got to put it to work. Their LPs want to see it put to work. We have strategic buyers that have healthy balance sheets and are looking to kind of improve their overall long-term strategic position. I think originally they thought valuations were going to come down a little bit, but the bottom line is there's a lot of competition out there for good companies, and therefore if you're in a process and you can create that competitive dynamic, we're seeing values kind of stay as they were pre-COVID. Ted, do you have any comment on that?
Yeah, just a couple things on that. The private equity community, where a lot of the market frothiness has been fueled by, we still see a ton of capital to be put to work. Time is not your friend if you're a private equity investor in terms of your ROI calculation. Where they really did shut down in March and April to shore up their current portfolios. We've seen them all back in market, all changing. Originally the dialogue was, we're never going to buy a business without actually meeting the owner in person and doing the thing. That's changed completely in the majority of the firms that we deal with, across the board, that they've gotten used to doing Zoom diligence, meeting with management teams. We've actually been able to close, a couple deals, completely virtually, global deals that involve, operating units, overseas as well. And Mark, as Mark said, the strategic buyers there is still, if you look at the cash on corporate balance sheets today, it's unbelievably high. So, we have, cash available for the markets. Combine that with the debt markets. The debt markets really did freeze in March and April. That's why a lot of private equity guys were out of the market. That's the same thing as the debt holders shored up their current portfolios. Debt is still relatively, inexpensive. We actually have seen a little correction in the underwriting, multiples on the debt side, i.e. not as much debt being put into deals, but we're still on a global basis, at that 50-50 minimum. So 50% debt, 50% equity, and recapitalizations are big private equity deals. So still a really good position to be in. I think as debt is used as a tool, the lenders that were doing ARR in technology lending are the ones that got in the biggest trouble, where the growth of some of those businesses got stymied, and we see some pretty significant businesses that had a lot of capital go belly up in the tech sector. But I think those were probably really aggressive underwriting non-cash flow oriented businesses and underwriting on an aggressive ARR, which is really just an annual recurring revenue number. And we still see a lot of that lending going on, but I think it's become a bit more conservative in the tech sector.
Yeah, and so that's from the buyer side. On the lower part of this slide, from the seller perspective, how they're responding in this COVID pandemic is the onus is being put on them to better document company operations and have kind of better, stronger back office in terms of accounting and controls and reporting. So obviously, when the brakes got jammed on in March and April, everyone went back to their P&L and huge intensive look at cost effectiveness and how could you protect cash and reduce cost. And that's kind of, I think it's paid off in dividends to the firms that were able to get through this or get through this better than most. And
okay,
so
the only last really thing there, Mark, on Conrad mentioned that there's an excess of cash on balance sheets. A lot of that was through PPP loans and other things, and that have gone into the deal. There was a lot of uncertainty on how PPP loans would be treated in transactions. I still think there is an uncertainty around that, but we've seen, the SBA now in a couple deals that we're doing actually issue forgiveness on those loans. And I think it's an issue that we've seen become, quote, more normal and having more normal discussions with buyers, not unlike net working capital, which is a normal kind of calculation that you've got to get your arms around. I think there are resolutions and solutions out there relative to that. So, early on, we thought that they would be, prohibitive, and sellers wouldn't want to, accelerate, kind of repayment. We just don't see that happening to date. I think there are still some question marks long term on how transactions will impact PPP loans.
yeah, Conrad and I were talking about that just pre-webinar here.
Yeah, the SBA has issued some guidance, at least with respect to asset sales, that in order to avoid having to ask the SBA for consent, and God only knows how you do that, you have to both, escrow the money, the principal, and submit a forgiveness application. Now, in the case of business licenses last week, there was a PPP loan, but the bank wasn't ready to accept forgiveness applications. So we just have to basically give it to them and take a picture of it to satisfy the buyer. So it's still fairly chaotic, Ted, but there's a little bit of guidance, at least on the asset sales side.
Yeah, we got our first, we're in the midst of the deal now. It's a stock deal, not an asset deal, but the SBA granted forgiveness. The core bank had granted the SBA, and now we're arguing that the SBA grants forgiveness via email. And all the lawyers are like, well, no, they don't, we need documentation. And so we're pulling up an email from the SBA, and they're like, no, you got to contact the SBA and get them. Well, that's not what they're doing. So you're right. There is a lot of confusion. There's a lot of back and forth on what actually, is happening and what a lot of these regulations are going to mean long term.
And you got to watch out about, like you talk technically, Ted, you don't want the PPP loan to fall on your debt bucket because it comes off the purchase price. You don't want it to go into net working capital because it's an adjustment of the purchase price. You got to treat it almost its own category.
Yeah, it's a carve out, and that's what we've been doing in most.
Right. So, amidst all this craziness, and people have, responded pretty intelligently in that they persevered, they adapted, and they've been more or less resilient in keeping the businesses moving, helping their businesses move forward. So, but in the midst of all this craziness, what hasn't changed are the fundamentals. And so the fundamentals of, managing and growing and driving a business and taking care of your employees and your customers and all that stuff has not changed one iota. So, what we have seen is, delays in certain in sales cycles and things of that nature. And because of that, as Ted mentioned earlier, we've asked companies to kind of hold off and get their house in order and be prepared to answer, document and answer any questions if they do in fact go through some sort of exit cycle in the coming 12 months, whether that's a full or partial exit. So
Yeah, the only comment here too, Mark, is that we've been preaching this same mantra for a very long time, and COVID was a great equalizer to actually see what companies, what management teams were really well run. And we had found, almost with no exception, that the companies that were well run, well managed, well thought out were able to adapt. And candidly, those that were not, kind of the weaknesses that maybe had been, lurking underneath the covers for a little bit, got thrown right to the top of the order there. So, companies that thought that they were in a position or thought their value was greater than it were really impacted, dramatically. So again, it really is just, a lot of the things that you do as a business leader and having a flexible strategy and being able to react to things going on in the market, really, came to the forefront.
yeah, absolutely. Well said. And, but as a result, and what Conrad mentioned earlier, as a result of this new type of risk being thrown at CEOs and boards, there was this, the way to manage that, the way for the buyer to get comfortable, and the way for the seller as well, to give the seller the opportunity to reclaim any value that they think they could grab in the next 12, 36 months. The earn-out concept was brought forward and has become part, a bigger part of the deals than we've seen historically. I don't know, Conrad, if you.
Oh, absolutely. That every deal we've done, except for one, has had an earn-out, and sometimes significant. And we're going to actually have a session that devoted to earn-outs later, later in this series. This way for the buyer to hedge risk, but there's a fundamental inconsistency in an earn-out, Mark, as that between the buyer's desire to integrate the business and your ability to show performance based on your historical business, and that tension is difficult to reconcile.
Yeah, and that's always the case, right? Always that reconciliation effort is always on the table, from a historical perspective.
When
Oops, we're losing you, Mark.
Did you lose me?
Nope, we just lost Conrad. I'll text him, but why don't you continue?
All right. So look, what we've seen CEOs do is really just go back and relook at things, do a hard relook at things. So if you look at this slide here, on the top side of the slide, CEOs and companies can control, and on the bottom side, including the pandemic, is what largely beyond the company's control. So you take another fact-based look at what's going on and figure out how do you get back on track, and what's going to enable you and what's going to constrain you going forward. And we saw CEOs do this in kind of record-breaking time. So it's been great to see teams get their act together and think through these challenges and respond accordingly.
Yeah, and just I'll mention we have a client that not a large company, sub 25 million in revenue, and they were opportunistic. They purchased 2 technology companies during this time that were great pieces of technology, but probably underfunded, undercapitalized. organizations, combining those companies, with our clients made inordinate sense for all around the table. They benefited from, doing some things, to build new products that directly impact, COVID, and drive revenue, and doing that, as the leader of bringing 2 to 3 joint venture companies behind the scenes to go to market. They'll more than double their revenue this year. And it was really more just thinking, being opportunistic, not only just shoring up your own, but thinking about how you're going to drive your business post-pandemic and where you can see value today.
Yeah, so again, this is just another way where going forward, if you look at a standard operating model, which we tried to build this out, this slide out, what's kind of top of mind with a CEO and a board and a management team. They dug deep into these things, and what's really changed, what they really changed so much, or a great deal, was their business processes, their adoption of technology, and how they motivate their teams and their customers to a certain extent. So using this as a framework, you can see over here to the right, the transformation side, there's just a great deal of rapid and detailed work that these folks did. And it was, again, great to see executives kind of step up and really do what they're being paid to do, and represent themselves and their management teams and companies well. So, what in fact, did they do is they revisited things in terms of, say, product development and innovation. They shut products down that weren't selling. You saw that even the folks from Campbell Soups do certain things, realign the product lines, realign the pricing, realign what they're going to push out to market. We saw some new development. Ted and I work in a segment in the mobility and telecom and tech management, tech spend management, technology management overall. And we saw companies like Modus, who we sold a company to about a year ago, use that technology to help bring out new product around remote work and managing remote workers, and the spend that occurs around these the mobile tools and the connectivity that goes from the corporate headquarters out to people's homes and whereabouts. Customer retention, and listening to the customer, and how these people engaged and might have changed pricing and might have changed terms. So look, I don't want to get into too much details here, but we saw people really improve the left side of the screen or readjust the left side of the screen so that they could do things on the right side of the screen, which is really, drive the revenue or maintain revenue, drive their cash flow. And this in turn is really good. This is a wealth maximization type of shareholder wealth maximization initiative to drive value upon an exit, again, whether it's a full exit to a strategic or PE-backed strategic, or to partner up with a private equity firm to continue to drive the change and growth that the CEO and management team are looking to achieve. You guys have any comments on that?
I can comment that we're going to do a wealth session later on in this series, so we can get you can get into more detail on what you just talked about, and people can then start to do an anticipatory structuring of their business and what will happen, assuming we are all successful in closing their deal.
Yeah, that's Lenny. That's become just such a hot topic now with the pending, I should say, change in the landscape in DC and potential tax ramifications and issues and the wealth management issues around that, and certainly in privately held businesses that are either family owned or led by individual investors versus professional investors. I think that's going to be a huge area to focus on.
Yeah, a lot of clients think of wealth management after they have the money in their hands, and it's a little late. If they structure things much earlier, they'll be much better off.
Yeah, it's too late. I'm always amazed to see shareholders kind of not respond or not engage with their estate tax attorneys, with their wealth managers, like way before an exit. It's just so prudent to do so. But look, this slide here is really, hey, we're back to the fundamentals. What's going to help you if you are going to exit, if you are going to raise capital, what's going to drive value? And so, no surprise to people is that buyers, investors, they focus on how fast you're growing, how fast your revenue's growing, how fast your market share in terms of individual clients are growing, and how you're managing margins to increase profits and create more cash for the business, more like free cash flow type of measurements.
Yeah.
So, sorry.
Yeah, I was going to say that short of having IP that is the asset in a business, and certainly there are industries where that is the case, and biotechnology, discovery, and some of the tech areas, growth, pretty much is driven, kind of the valuations that we've seen, right? Growth industries, growth markets, looking for those. It's all relative, compared to growth, compared to what? Well, growth compared to, your industry, your peer companies. And I really think that drives a lot of what we're doing. And I will tell you, it's not just revenue for revenue growth perspective. It's margin, the gross margin, growth, and productivity and scalability in that. And then in particular, what I would tell you is that, how you're going about achieving that growth has become laser focused by most investors. Looking at the cost of customer acquisition, are you frivolously spending on going to get, customers and really not ever going to come out the back end, right, of the revenue model that you have. So it's not just blind growth. It is a bit more sophisticated on how you actually get down to that next level. But in general, the valuations that you're seeing in the marketplace are the premium companies really, growth is the number one and number two factor that most buyers are looking at.
Yeah, totally. Like I said, back to the fundamentals. We're back to the future here. It should be no surprise that point number 3 above, the most critical value driver is growth in revenue, and growth in margins and cash flow. So
let me just make one point on that, if I can. It's, a lot of companies, when they approach a deal and they're in the midst of the deal, they lose their focus on their business, and then the chart on the right side doesn't happen. There's no growth. There's a stasis of their business. And COVID was an example of that, where they changed their focus in many places for survival. There was no growth. They just maintained. Those that were already technology-focused businesses, as you guys have both mentioned, have done extremely well. There are those outliers where it's a technology purchase. They're buying the technology. They're not buying the growth, the opportunity, and so on. And those are great opportunities when they present themselves. But for every other business, they want to see the management team run the business, everything, all the fundamentals that you're talking about. And COVID is a shock to the system, and those that manage through it and run back, as you said, Mark and Ted, to run back, focus on the fundamentals and drive through. That's the team that the investors want to buy. And it's shocking that some panic, but others, the only bad thing that they've done in the management is that they've held on to cash. And as Conrad mentioned, they have too much cash on their balance sheet, and it's impacting other things, but that's a good problem to have. And that can be adjusted if they do things, if they counsel with you or with us before a deal. But
Lenny and Mark and Ted, as we're getting towards the end of the hour, Feel free to ask questions on the Q&A. If we don't get through the whole presentation, we'll make the presentation available to whoever wants it. But if you have questions, just type them in. We can actually bring you up live as we close out the last 10 minutes here.
Yeah. So really, I mean, what Flatiron and Falcon are going to try to do over the next several webinar sessions is we want investors and owners and management teams to think about how best to exit. And we're all on the same page where we believe your best exit plan is a growth plan. So you have to, and there's no perfect time to do this, but to Conrad's point and to Lenny's point and all of our points, the COVID really was this hand grenade got thrown at us, and it's forcing all of us to re-examine how we compete, where we're going, how we're going to get there, what's going to make us successful. And what we want to be able to do over the next several webinars is to talk about how you prep, how do you project and do some value analysis, and then how you begin to execute so you can realize all that. And if all that stuff is going well, you can exit. If it's going well today, you can exit tomorrow. There's plenty of buyers out there looking for good assets, whether they're filling in a geographic hole in terms of geography, or a gap in their product portfolio, or the need to have newer technology replace what they might have in place, or even management teams. And Ted's working on a couple deals now where the much bigger buyers are looking at the smaller seller and saying, shit, these guys have exceedingly good management and processes, and we're going to start using these guys. So our synergies are going to figure out how to use these people and processes better. So again, so your best exit plan is a growth plan, and we think we're advocating that what you should do is do this as a team approach. I think there's a couple takeaways here. That you should have some legal assistance, whether that's from the corporate exit side or from a trust and estate side. You should have some financial expertise. We're seeing buyers respond very favorably if sellers have strong accounting and have possibly even done a sell side quality of earnings to confirm cash flow and confirm that by an outside third party. Of course, there's a whole bunch of other advisors you can bring to the table, and based upon who you are and the needs of the situation. And lastly, we also think you ought to talk to a wealth manager to kind of just see how what you can be doing to protect your wealth when it comes and to you, and then to distribute it properly in the capital markets wherever you want to distribute it to.
From our side of the ledger here, I think as Mark was kind of hitting on that, understanding what the value of your company is is an extremely important strategic tool. And 9 times out of 10, we'll get a call from someone that got inbound calls from private equity firms or strategic, and they said they want to buy us. And it's kind of you go into the call to the Falcon is, hey, what do you think we're worth? And it's literally over the phone they want us to tell them how much they're worth. And obviously we're as schooled and educated and researched as anyone in our industry, so we can throw market norms and values out. But unfortunately, it doesn't work like that. So if someone comes to us and we say, hey, you're worth 4 to 6 times revenue, but the market multiple is to that. But if you're not cloud native, if you're an on-prem versus a cloud-based software, it goes on and on and on, that you may not even be in that range. You may be a 1 to 2 times revenue company, even if you're 10, 20, 30, 40, $50 million. So understanding what drives value is one of the fundamentally, I think our view of the world, so Mark and I ran companies looking at that and then doing something about it, right? In English, right? You can choose not to accelerate your growth. You can choose not to change your tech platform. You can choose not to go after a bigger total addressable market that you're in, but at least you understand what's going to drive value. And a lot of that discussion comes from that inbound inquiry that folks are looking at. So it's all part of that planning mantra that we're really big on. I know Flatiron is as well.
So Conrad, that's really what Ted and I have. If there's any questions that are coming in, by all means, we're happy to answer.
There are currently no questions posted. Conrad, why don't you do a little wrap up and summary, and maybe someone will step up. We still have 19 people logged on, and as you do your wrap up.
So thank you for attending our first session here. As I mentioned, there's 5 additional sessions that we're going to do. The next one is going to be focused on the patterns that we're seeing in deal structure. We're talking a lot about deals are getting done, but buyers are hedging their risk. And in part, they do that by pushing all or some or part of the purchase price into earnouts. Some of that we're seeing is by doing asset sales so they can leave liabilities behind. That asset sales create all kinds of tax challenges, which goes back to Mark and Ted's slide about having a CPA ally with you. So we're going to talk about what we're seeing in structures right now. We're going to have a session on getting the company ready, particularly in this environment where putting your best foot forward is critical. We're going to have a session on negotiating in a pandemic, negotiating with a weaker hand. We're going to have wealth management, and of course, as I mentioned before, we're going to have a session dedicated specifically to the earnout, my favorite legal question. Our next session is going to be on Wednesday, December 9th, in about a month. We'll send out some reminders. We'll send Mark and Ted, if you're okay, we'll send everybody the presentation, and we'll post the presentation on YouTube and go from there.
Terrific.
Okay, folks.
You have a question, Mark? Lenny?
Yep, that's we've hit everything. There are no questions pending. So for those of you that do have questions, when we send out the materials, you'll have the email addresses for Mark and Ted, so that you can pose questions directly to them and reach out to them. And obviously, you can always reach out to Conrad and I. We thank you for joining us today. And as of right now, our session is closed. Thank you for your time and enjoy your weekend.
Thank you, everyone.
Thank you.